Hi everyone, welcome back to the podcast. Today I'm going to talk about some golden rules which I put in a LinkedIn post. I'm going to talk further about that, the golden rules to getting you financially successful, have money so that you're free from the burdens of not having enough. Many folks find themselves in the same financial spot throughout their lives, no matter how much they earn. Think about it. If you go to a regular job, you might get a raise now and then, but often it covers the rising cost of living, the inflation, and you don't really feel richer at all. Fast forward to retirement, even though you're earning more than you started, there's not much left in the bank to show after all those years. Some of us are heading towards that, some of us have reached that, some of us can see that ahead of them. Now, if you're out there hustling on your own, trying to start a business or freelance, the odds can be tough. And there are multiple studies, and I'm sure you've read them, show that many entrepreneurs face financial challenges and many businesses don't even get past the 5th year mark. Hey, but you did give it a shot. So you got that much. You never know, right? But here's the thing, no matter where you are financially right now, there's some golden money-making rules which I thought I'd share with you, which can be maybe game changers for some of you who have not thought of this. Sure, 10 years, 20 years, might sound like a really long time if you're very young, in your early or late 20s, like case of McCarthy here. But trust me, it goes by very fast. Someone who's sitting at well past 40, 45, 46, I can tell you this, it goes by very fast. But if you're just starting out in your career, these tips can set you up for a more comfortable future than most of my peers are at right now. And if you're thinking, I'm in my 40s, it's too late, well, think about this again. Retirement is still a couple of more decades away. A lot of you can change that in time. After all, Rome wasn't built in a day. Chennai wasn't Chennai overnight. It does take time. As you see our metro project happening in our city, everything takes time. All good things take time. And we are told, and we do believe, that the pains of what we're putting up with our traffic today will offer us a better future tomorrow as our city grows. But here's a quick and easy, there's no quick and easy way to getting rich. And if there was, all of us will be doing it, won't we? Building wealth is a journey. It's about understanding the power of change, and your financial future is always in your hands. Remember that. So in this piece, I'm going to share 5 golden rules to making money. And trust me, if you stick with them, you'll see a difference in the long run. Grasping the idea of guilt-free spending is the first thing I want to talk about. To get to grip on saving, you don't have to dive deep into your spending habits. It might seem counterintuitive to most of you when I say this, but to figure out how to save money, you first need to see where your money has been going. Spend an hour, go through your bank statements, and for the past year, tally up all those expenses where either it was unnecessary or just frivolous. You'll be surprised for the amount you could have saved. The real issue is, for many of us, it isn't the splurging on silly things, it's that we do it way too often. And if it sounds like you're not alone. It's truly improve your finance. It's essential to cultivate a guilt-free spending mindset. And here's some tips on doing that. Set aside a small fraction of your monthly earnings, 2%, 5%, for those impulsive buys we all love doing. If you're saving 5% each month, that doesn't cover your fancy gadget, you have been eyeing, no worries. Then separate a guilt-free savings account and automate monthly transfers into that account, and just wait till you have saved enough to buy that purchase. So like how I say, create a separate savings account to invest, create a separate savings account. All our banks are chasing us. Every single bank is chasing you to open a savings account. Your existing bank bank manager will be happy if you open one more account to meet his target. So create one for just your frivolous spending and transfer every month. Automate 5% goes into that account, and only carry that debit card and have that account into your GPay. So that way, that's it. So you feel not guilty because you know you've set aside this much money, and you'll be you're spending much more guilt-free, and you can do all your frivolous spending without having that guilt of spending. Now, I'm not saying that you should skip your 150 rupee chai or coffee day or Starbucks, and you have to work yourself to it. Trust me, no one became crorepati by cutting out daily brews. No one gave up Starbucks coffee and gave up Sarvana Bhavan dosas and became crorepatis. I'm not saying this. And for those of you who claim that the local tea stall doesn't really taste good, just they're not getting it. But by curbing unnecessary expenses annually, not only will you foster better financial habits, you'll also have a decent amount of saved up and smarter choices, which we can discuss next. Invest 10% of your net income into Indian stock indexes. You don't have to go to US and diversify and all that complicated things you don't have to start with. Keep it simple. Start investing 10% of your net income into Indian stock indexes, which you might not have come across this advice before for some of you. Who has come to this video the first time or this channel the first time, but there are reasons why it's so popular. It genuinely works wonders. While investing a bit in Indian stock indexes like the Nifty or the Sensex, you won't make your crorepati instantly, but you'll be patting yourself on the back. By a decade or two from now, you'll be well on your road to becoming one. Investing a consistent sum in an index fund every month is a technique known as a rupee cost averaging. It's packed in with benefits. Most ETF funds, which track indexes like the Sensex and the Nifty, come with minimal fees levied by your broker. Just like a regular stock investment, you can offset your losses against your taxes in the year if you don't fare well. Though such years are quite rare. In an average year, you can expect about a return to around, I would say, 10 to 11% on a long period of time, and you should be able to beat the inflation here in India and have a stellar year if you look at the long term. And your risks are minimal, and if you're patient, you will recoup anything which you suffer in a year because you're betting on the Nifty and the Indian economy and the Indian country as a whole. As long as we're around, I think we should be finally doing well. And if you don't believe all this, you can always pull up the stock chart, the Nifty chart for 10 years, 20 years, or the Sensex chart for even longer periods of time and see how the graph looks. Your monthly contributions can act like a small buffer during downturns and amplify your returns during good times. So the last point is crucial, so let me break this down. Why I'm saying you should keep consistent investment. Let's say the first year you invested around 2 lakhs and you face a 5% dip and you're down by, let's say, 10,000 rupees. The next year you have invested another 2 lakhs and this helps you offset the earlier losses, but your total now is 3,90,000. But the second year the index has gone up by 3% or 4%. So your net growth is actually 4 lakh plus. So this is what I mean. By consistently investing over a long period of time, you will average out. The initial balance might seem insignificant, like a minor up or down. But fast forward 10 years, 3 years, and these 10%, 5%, 2% slowly adds up and becomes a substantial boost in your portfolio, creating you returns, beat inflation in the long term, and give you handsome returns. For entrepreneurs and business owners out there, parking a part of your earnings in indexes like Nifty and Sensex is also a smart move. It offers financial safety net and independent of your business. So you don't have to rely on your business being good or bad in a year, and you have something kept aside just for yourself in case businesses do turn down. And all businesses go to a positive cycle and negative cycle. So being an entrepreneur, a business owner, you should be aware of this. So if you do turn into a negative business cycle, you would have been smart enough to keep some of your money parked in Nifty and Sensex indexes, so you have something as a safety net to fall back on. Plus, it instills sound financial habits that can be influenced into running your daily businesses. So it can be a positive feedback loop for you. Those kind of habits which you use in your personal finances will start bleeding into your daily business habits. If you're keen on starting an investment journey, here are a few index funds which you can maybe consider, like the Prudential ICICI Nifty Index Fund, HDFC Sensex Plan, or the UTI Nifty Index Fund, which Anand has always been very fond of. Please remember, I'm not a financial advisor. I'm only giving you my opinion and what I think you can be doing and what I'm doing myself. So do talk to your financial advisors and find out what is right for you and what is correct for you based on your goals and your plans. But remember, the key is consistency and patience. Sometimes out of the blue, we all receive unexpected money, like a bonus, an inheritance, or an insurance payout, or even famously, some of us do get a tax rebate. Many of us have the urge to splurge when this happens. We're like, this is free cash. That's perfectly okay. But it's a strategy and a discipline around how you use this money that matters more than the actual spending or investing. It's essential to set a limit on how much of this unexpected money you'll spend and how much you'll invest. It can be any number you choose. Now, investing doesn't always mean putting your money into stocks. You can invest in yourself, maybe buy yourself something you wanted for a while. That is also investment. Spend on a home improvement, which is also an investment. Remember, investment is always not about putting it in the stock market. I'm sure my brother would not agree on this, but I wanted to get it out there. So let's say you get a tax rebate of 75,000 rupees. You don't necessarily have to invest 37,500 in the Sensex immediately or go to the Nifty and put that in Nifty immediately. You don't have to. If you don't have any pressing needs, then don't hesitate. Move the money into your investment account. But if you do have some pressing need, go ahead and do that. Don't feel guilty about it, like I said before. Now let's talk about credit card and credit card benefits. Yes, if you do not have financial discipline and if you don't have the mindset to pay your credit card bills on the day they're due, please don't follow this. Let me say this again. This only works if you pay your credit card bills on the day they're due. I'm not talking about taking any EMI plans. I'm not talking about using credit smartly and wisely. I'm talking about credit card benefits if you are paying your bills on time. When funds are tight, it's wise to stick to debit cards. Remember this. Debit cards also offer these kinds of benefits, which I'm going to be talking about. And they also prevent overspending and they have no interest. They're directly linked to your bank account, so you'll feel the pinch immediately when you're spending, and this will encourage you for better management. Many of us misuse credit cards, spending money that we don't have or accumulate interest on unpaid balances, which is why I strongly urge you not to use credit cards unless you have the discipline. But if you do have this discipline, credit card comes with many perks which many aren't aware of. And if you're disciplined with your credit card usage, these perks can be beneficial. And if you're struggling with credit card debt, these benefits might come as a relief for some, but I would argue better not to use it. First one is travel rewards. Many cards offer cashback points and travel-related expense rewards, which can be accumulated and used. 2. Cashbacks. Many cards provide cashbacks for specific outlets or specific times of the year, which can be used, which can be a huge saving. These 5%, 10% adds up quite a bit. This is a lesser known one, which is purchase warranty perk. If you damage your product, which is bought on the credit card, some credit card companies offer cover of the cost also. They offer you insurance for your product or warranty. Not all of them, some of them do. The other one is fraud liability guarantee, which most cards have because it's been mandated. They ensure that you're not liable for any unauthorized transactions. So you can safely use the card online, and in case something happens, if you report the fraudulent transaction immediately, you are protected. However, it's best to avoid credit cards when possible, but if you do use it, these are the benefits you can be aware of. That again, like I said, if you have the discipline. Another one which I want to talk about is trading. Trading is not the same as investing. During the pandemic, a friend of mine made 7,50,000 on a trading app. But as things were normalized, he lost 5,25,000 rupees. Such apps encourage frequent trading, which is how you earn and lose money very fast. But most users lack knowledge and often make bets based on trends and hearsay, and consequently lose 90% of their day trades. They lose the money. So a piece of advice is avoid day trading, especially day trading apps, and that make buying and selling shares seem so easy, like ordering food. It's not. Trading requires expertise, which many of us don't have, and many don't have the inclination to learn it also. So viewing trading as a quick way to wealth, often based on tips or from acquaintances, can be devastating. True investing is often very dull, straightforward, and boring. Consistently investing a set amount in a few instruments. Don't cherry pick stocks. Don't cash out your profits. Don't even need to check your monthly gains or losses. True investing is often dull and straightforward. Consistently investing a set amount in a few instruments can give you the rewards. Don't cherry pick stocks. Don't do that. I'm talking about index. Go ahead and put on a Nifty or a Sensex index. Don't cash out on your profits. When you have a good year, say, okay, I'll check out my money right now because I made so much. I made profits, let me spend some of it. Don't do that. You don't even check your gains monthly or losses monthly. We're talking about investing long term. So stick to your plan, and a decade later, you'll be grateful that you did. Here's to building wealth, and enjoy your journey. I hope you found this video useful and informative as always, and I'll see you in the next one tomorrow.